All right, Chapter 2. Chapter 2 is analyzing transactions. So we've introduced the three basic financial statements in Chapter 1 by going through, in the problems that we did, we went through and created the income statement, this retained earnings statement, and the balance sheet out of an alphabetized list of account balances. Well, the whole process starts with analyzing transactions as they occur. So every time a business does anything, they buy some new inventory, they pay an employee, they pay some insurance, they pay some rent, they buy a new piece of fixed assets, long-term tangible fixed assets like desks and chairs and computers and the like. Every time they do anything, they have to analyze, an accountant somewhere, and oftentimes it's computerized for the normal things. Like when you go into HEB, you scan something. If you go up to the self-serve kiosk, you scan a bag of chips and a bottle of water. Well, what happens to that? Well, one, HEB recognizes some revenue for the price that you paid, right? And let's assume you paid cash. So they're going to debit cash for those two items that you just purchased, and they're going to credit sales. Probably two different categories of sales, because they've probably got accounts for water alone and accounts for chips or something like that. So there's revenue that is generated. That's one half of the equation, because what else happens? They've got one less bottle of water and one less bag of chips in inventory. So they've got to remove that asset out of inventory and expense it to their chart of accounts. So that's cost of goods sold. So two transactions happened with one swipe of that scan. All right? So we're going to go over numerous examples, and we're going to start with problem number 2-1A. On page 90. So on this one, the problem is asking you to create a series of T accounts. T accounts are just representations of a journal. All right? Account journals are journal entries are done chronologically as these transactions occur. All right? So that's a journal entry. Then you post them to the ledgers. All right? So we're going to analyze these transactions and we're going to post them simultaneously. So the ledgers are cash, and this is just a T account with debits and credits. Accounts receivable, equipment, supplies, prepaid insurance, automobiles, so all of this are the assets that this company called Manis Architects, all of the assets that they own in order to conduct their business. So this is all assets. The liabilities they're going to have are notes payable, accounts payable. That's it for liabilities, just those two. And the only difference between it is an accounts payable is an informal promise to pay, whereas notes payable is an actual legal document. You sign what is known as a promissory note. If any of you have ever bought a car or a house or a condo, you signed a promissory note. That's a legal document that can be taken to a court of law and they can get a judgment on you. Accounts payable are just informal handshakes in essence. They're called trade accounts. Then for stockholders' equity, they have common stock, and then for revenue and expenses, which is what's going to fold up into eventually retained earnings, they've got professional fees, and then they have 5 expenses: salaries, blueprint, rent, automotive, automobile, and lastly, miscellaneous. So these are all their accounts. And every business has what is known as a chart of accounts. It's a listing of every account that they have deemed necessary to categorize all of the business transactions that they run into on a daily basis. And they change, because sometimes you get a transaction that doesn't fit neatly into a little bucket, one particular account. So you create new accounts. They're generally numbered. All right? They're numbered. The 1000s are assets. Anything that starts with a 1. And it could be a 2-digit account number, 3-digit. It can be a 15-digit account number. I saw in a textbook a while something associated with Nestle's, the people who make chocolate. They had a 15-digit account number. You know, they had the first 5 digits were identified the various accounts, cash, accounts receivable, and the like. The second 5 digits were the division, the various divisions that they had around the world. And then the third one was individual locations for departments and the like. So complicated. But they're always numeric, because people who do data entry use a 10 key. Use those little numbers there on the far right side of your keyboard, on a full-size keyboard, not your laptops for the most part. And that's all they do, is punch those numbers. So if you give them an alphanumeric, you put letters in the middle of their account numbers, they will quit in mass. I'm just telling you. They will just leave that day, because then they've got to use their left hand, which is what they're doing to hold the paper. They want to use the right hand. I was working for an aerospace company that was installing a new computer system, and I happened to walk in there the day they were redesigning my chart of accounts. They had a whole team there. And there was a guy that worked for me from the accounting department that was just sitting there silently while they were discussing alphanumeric account codes. And I just looked around the room and I go, what have you guys been drinking? Are you crazy? Every one of my accounts payable clerks would have quit that afternoon. Said, no, it's always numbers. And they looked at me and they go, well, why does it have to be numbers? We'll get more variety if we put letters in there. And I went, 10 key, folks. It's all touch 10 key. Right? So each one of these, so assets would have a 1 on it, say 10 or something like that. Liabilities would have a 2, start with a 2. Stockholders' equity is 3. And then it varies from company to company. Most 4s are revenue, and then 5s are expenses, in a very simplistic. You could have more than one revenue stream. So revenues might be 4s, 5s, and 6s, and then expenses are 7, 8, and 9s. So it varies from company to company. But the asset, liability, and stockholders' equity, you can go anywhere in the world and look at an account number and look at the very first digit, even that big 15-digit one from Nestle's, and you know immediately what type of account it is. You know that it's an asset if it started with a 1. It's universal. Okay? All right. So, now that we've got our various ledgers up here, we can analyze the transactions. So this one is Kimberly Manis, an architect, organized Manis Architects on January 1, 2016. During the month of January, this is all January, they completed the following transactions. So the first one, issued common stock to Kimberly Manis in exchange for $18,000 in cash. All right? So 2 accounts are increasing. An asset account and a stockholder's equity account. So $18,000. And then stockholder common stock, $18,000. The next thing that Kimberly did was she paid rent on an office and workrooms. So she paid for January $1,950. So because she only did 1 month, she didn't do 6 months or 3 months or anything like that. She just did 1, we'll expense it on the day. If she did 3 months, then it would go into a intangible asset called prepaid rent. And then you would expense it as each month went by. But she's only paying it one month at a time. So B is $1,950. Then she purchased a used automobile for $28,500. She put $5,700 cash as a down payment, and then she signed a note payable for the remainder. So she's buying an asset, an automobile. So C, for the asset side, the debit is $28,500. She paid, I didn't put the B side up here. When we paid the rent, that was a credit to cash. Always 2 transactions. All right? Now, the first midterm is next week. All right? I'm going to give you 5 transactions, similar to what we're going over today. 5 transactions. I'm going to give you a journal where you can actually write the transaction, debits and credits. I'm then going to give you a piece of paper with these T accounts on it. All right? So you can use the piece of paper as your guide to write the journal entries. And the next problem I do, I'm going to write the journal entries up here rather than the T accounts. So the first problem I'm doing T accounts, the second one I'm doing journal entries. All right? So I'll show you the debit and credit. All that is that would be a debit to cash, that would be left justified, and then you would indent common stock. That would be the journal entry. And then you post those to the T accounts, which is the ledgers, and then get a balance. And once you get a balance on all the T accounts, you can do the income statement, the retained earnings statement, and the balance sheet. So that's going to be the test next week. 5 transactions worth 10 points each. All right? And then 50 points, 20 for the income statement, 10 for the statement of retained earnings, and 20 for the balance sheet. Okay? And on the next problem, I'm going to do that full cycle. I'm going to write all the journal entries up on the board, and then I'll know what the total is, and I'll go to the financial statements and show you exactly how to do it. Only the problem I'm doing here in class and videotaping is much, much more complex than what I'm going to give you for the exam. I'm only giving you 5 transactions. And then from those 5 transactions, you can post those to the T accounts, which is the ledgers, and then do the financial statements based upon the ending balances. Okay? So that's next week. All right. So C, the rest. So the debit is to automotive, and one of the 2 credits is to cash for the $5,700 down payment that we made. So if we made $5,700 in cash down payment on an automobile that cost us $28,500, that leaves us $22,800 balance in the note payable. Okay? That's just the $28,500 minus the $5,700. So bring a calculator next week. You cannot use your cell phone. You cannot use the calculator on your cell phone, because the cell phone also allows you to take pictures of your exam and transmit it to your friends sitting around here. I learned that. I graded an exam in China a long time ago. This is 2002, a long time ago. And people were posting journal entries wrong, but yet their financial statements were right. And I'm looking at this thing, I go, I've been a CPA for almost 30 years. I couldn't do that. How in the heck are they doing it? So then I thought, they're taking pictures of the answer and sending it to their friends, and their friends are just writing it out based upon, because they all had their cell phones. So I went down that afternoon to a place in Guangzhou called Idalu, which is a street that sells wholesale stuff, and I bought 120 calculators. And I still have some of them. They're solar powered, so if you don't have a calculator, I'll bring a bag of them next week that were very, very cheap. I think I paid 15 cents a piece for them in U.S. But this was 2002. Anyway. All right, so that's the C transaction. So every transaction has at least 1 debit and 1 credit, but they could have more. In this case, both cash and the note payable. D, we purchased office and computer equipment on account, $4,500. So this is just generic equipment, $4,500. And it's on account. So we didn't sign a legal document, a promissory note, promising to pay this office equipment supplier. It's just a promise, informal promise to pay. So $4,500 D. Okay? E, we paid cash for some supplies, $1,875. $1,875, and we paid cash. F, we paid cash for an annual insurance policy. $3,600. So this is prepaid insurance because we're going to use this insurance all year long, not just for January. So we're going to put it into an asset, and then when we get to chapters 3 and 4 and 5, you'll see we'll make adjustments to that asset every month as 1 month of the insurance expires each month. So F is $3,600. And we paid cash for it. G, we received cash from a client for plans delivered. $13,650. So they paid us in cash, which is nice. And this is professional fees. $13,650. And that is transaction G. Okay? So under professional fees. H, paid cash for miscellaneous expenses. So that's all the way down here. H, $2,600. And whatever that was, it doesn't say, we paid cash for it. I, we paid cash to creditors on account. So we only have one creditor. That's the accounts payable that we generated when we bought the computer and office equipment. So the I is $3,000. So we're paying down that invoice, and we're paying it down with cash. Your creditors are going to insist on cash payments. So remember that. All right? Everybody with me so far? Okay. Home stretch here. J, we paid the first installment due on the note payable, $950. We paid that in cash. K, we received an invoice for Blueprint services that is due next month for $5,750. So this is, $3,750. So that's accounts payable is the credit, and Blueprint expense is the debit. L, recorded fees earned on plans delivered. Payment to be received in February, $21,900. So this is accounts receivable. It's the opposite of accounts payable. This is an informal handshake agreement with our customers that they are going to pay us for services rendered. In this case, we delivered some plans and sent them an invoice. So that's L. $21,900. And just like back in G, if they paid us in cash, the credit is the same. Whether they pay us in cash or they promise to pay us, it's both professional fees. So $21,900 is L. All right, the last two. Paid salaries to assistants, $4,100. So the debit is salary expense, M, 4,100. And just like your creditors, your employees are going to insist on cash. They're not really happy if you just give them a promise. I promise, I'll pay you Tuesday. No. It's not going to work. Paid gas, oil, and repairs on the automobile for January, $1,300. So this is our last little expense T account up here for automotive. And that's N, $1,300. And it says we paid it. So, 1,300. At that point, you're ready to do financial statements. Because all you have to do is total up all of the debits and credits and get a balance. So in this case, the balance in cash is $6,575. That's adding up the two debits, which is $31,650, and subtracting whatever the total of all the credits are. The accounts receivable only has one transaction, as does equipment, supplies, prepaid insurance, the automobile asset. The notes payable has a balance of $21,850. Accounts payable has a balance of $5,250. Common stock just has one transaction. Professional fees have two. They total $35,550. And then everything else is just a single transaction. Right? Everybody understand? So at this point, you could write an income statement with revenue of $3,550, deduct the expenses, salaries $4,100, blueprint expense $3,750, rent expense $1,950 on down, and come up with net income. Net income added to beginning retained earnings of $0. There were no dividends paid in this case. So whatever the net income is the ending balance of retained earnings. Your assets include $6,575 worth of cash, accounts receivable of $21,900, equipment of $4,500, supplies of $1,875, prepaid insurance of $3,600, and an automobile of $28,500. Add all that up, that's your total assets. Your liabilities are $21,850 in notes payable and accounts payable of $5,250. Stockholders' equity is $18,000 plus whatever net income calculated out to be. And at that point, the assets will equal the liabilities plus stockholders' equity, and your balance sheet will balance. And you'll have a big smile on your face next week because you must have done everything right. All right? So what if you, yeah, go ahead.
Where did you get the 6,000?
I added up all of this which I know what this one is. This one's $31,650. I don't know what that totals up. But then I subtracted that total from that total and got $6,575. My answer key didn't total it for me. So I don't know what that side of it is. Okay? So here's the secret. What are you going to do next week when you get to the very end and your balance sheet does not balance? Besides panic. Because you're guaranteed if the balance sheet doesn't balance, you've done something wrong. I'm going to give you 3 hints. This is what I tell every new accountant that ever came to work for me on how you go about finding a problem. You take the difference between your assets and your liabilities plus stockholders' equity. You take the difference. Let's say in this case the difference is $3,500. You look for that in all your journal entries. And sure enough, you've got that number as part of the transactions that you analyzed. What you did was you didn't post or didn't write one side of it. You might have posted the debit to the blueprint expense account, but you didn't post the credit, which was accounts payable. All right? So you didn't post one of your journal entries to the proper account. Step 1. Step 2. You take the difference. So you look through your transactions and you look and see if you can find that number. And if you find that number, go back and trace where the journal entry was posted to the T account and see if both sides are there. More than likely they're not. All right? Everybody understand that first tip? Second tip, divide the difference in half. So in using the same example, the difference between your assets and your liabilities is $7,500. Now what have you done? You've posted a debit as a credit. You wrote both the credit and the debit over on the credit sides. You've posted it to the wrong column. That will result in twice the error because you've understated all your debits, but you've overstated all your credits. So you divide it in half. Okay? If that doesn't work, your last final ditch effort is divide the difference by 9. If it divides evenly by 9, whether it's 9 or 90 or 900 or 9,000 or 18 or 1,800, 18,000, you've done what is known as a transposition error. If you either posted it or punched it in on your calculator, if you posted this as $570, not $750, the difference between those two numbers is $270 even. It's a transposition error. You either fat-fingered it while you were going through your calculator, or you wrote it down wrong, and you just flipped them. Okay? Easy fix. Yes, sir.
Can you just go over the last two one more time?
Okay. Divide it in half. If you find that number, back to our original, if that number was, when you divided it in half, let's say the difference is $7,500. So divide it in half is the $3,750. It's still this transaction. But what you've done is you've posted both sides of the transaction to either the debit column in both accounts or the credit column in both accounts. All right? Or last ditch, you divide the difference by 9. And if it evenly, without the decimal points, no point 5, 6, 7, nothing after the decimal point. If it's even, then what you've done is you've written it backwards at some point in time. So the example here is you've written 3,750 as 3,570, and you've punched it in that way. Okay? Yes? And if that doesn't work, just turn in the exam. It's not going to cost you the whole thing. I'll find the problem and tell you about it and take a few points off. Okay? Because you've done all you can do if you don't do that. All right? Everybody got this? All right. Let's do another problem with journal entries this time. Problem 2-4A on page It starts on page 92 and finishes on page 93. So page 92 to 93. And what I'm going to do with this problem is I'm going to post the solution to it on Blackboard. So when I get finished uploading my video to YouTube and I post the link on Blackboard under Chapter 2, so that you'll see it under the Chapter 2 heading down there where your pre-class homework and your post-class quiz is. Attached to that, I'm going to attach a file, which is a Word document with this solution, because it's got the journal entries written in an actual general journal. And it has this posting reference, and the piece of paper I'm going to give you next week looks exactly like this. It looks exactly like the journal. And all of the journals are then posted to the ledgers. You know, the cash ledger, the account ledger, the prepaid insurance, office supplies, and all that. And it has all that. Okay? So what I'm going to do right now, and I'm not going to do all the journal entries because I only have, I've got 40 minutes. Because I want to go all the way through producing the actual financial statements and show you the end of the cycle. Okay? So I'll do as many as I can, and then I'll jump ahead and do the financial statements. Because you'll have this to reference to. You've got the problem in your textbook on page 92 and 93. I'm going to post this on Blackboard so you can see what the solution looks like. Okay? All right. So, Elite Realty acts as an agent in buying, selling, renting, and managing real estate. The unadjusted trial balance on March 31st, 2016 is as follows. And you can see in that problem that there's cash, which is account number 11, accounts receivable 12, all the way down through land, which is 16. So every one of the assets that this realty company owns in order to do their business starts with the number 1. Liabilities, they have 3 of them. They have an accounts payable. They have an account called Unearned Rent. Remember in the last problem I said if you paid 3 or 6 months of rent in advance, you would have an asset called prepaid rent? Well, the opposite side of that on the landlord side is unearned rent. So if a customer gives you money for services or product, in this case rent, in advance, they haven't earned it yet. The most common example of unearned revenue is airlines. The airlines have huge unearned revenue accounts. Because what happens when you buy an airline ticket? Do you promise to pay them 30 days after they fly you to Bali? No, of course not. They won't let you get on the airplane. They won't even let you confirm the reservation until you pay them. You have to pay them in advance. It's a beautiful industry. It really is. Because if you don't pay them, you're not going anywhere. All right? So that's unearned rent until you get on the airplane and they take you to Bali. At that point, they've earned half of it. And they can take that to revenue for that particular month. If you come back from Bali 6 months later, and I really hope you do go to Bali for 6 months. It's a beautiful place. Anyway, if you come back 6 months later, then they get to earn the other half of it. It's still unearned rent until you fly home. Okay? All right. So there's all what they started the month with. And then in the month of April, they had the following transactions. So on April the 1st, they paid rent on an office for the month of $6,500. So this is all in 2016. It's April the 1st. And we're going to debit rent expense. Which is $650. Or $6,500. And what would be the credit? It says we paid it. So what's the other account? Any guesses? Cash, exactly. The only way you pay things. All right? Now, it's, yeah, a lot of times in tradition on financial statements, the very first number on any page, they put a $sign in front of it, but I'm not worried about that. Because nowadays the computer does that for you automatically, when you generate it out of a accounting package. So I'm not worried about that. I just want you to get the number down right. That's, the bar is really low here. I just want you to get the number down. Second thing we did was we purchased some office supplies on account. So this is on April the 2nd. Office supplies. That's an asset. And it's on account, so that's accounts payable. And 2,300. We paid an insurance premium for $6,000. We'll assume that it's more than a 1-month insurance policy, so we're going to put it into prepaid insurance. So 5. And we paid it, so that's cash. 6,000. On the 10th of April, we received some cash from clients on account. So what that means is that you have rendered services to your clients, you've sent them an invoice sometime in the past, and now they're paying you. All right? Because it says on account. Didn't say received cash for services rendered. It's on account. So the debit on the 10th is to cash, and the credit is to accounts payable. And the amount was $52,300. Yes. It says received cash from client on account. So just like when we bought the office supplies on account, this is a payment of an invoice that we have given them at some time in the past. And I'll actually, let's see, do I have one? No, I don't have one where a client paid us cash. No. On the 15th, we purchased land for a future building site for $200,000. We put $50,000 in cash down, and we gave a note payable for the remainder. So on the 15th, we bought land, we paid cash, and so the land total price was $200,000. We put $50,000 in cash down. I'm sorry, $30,000. I can't read. $30,000 in cash down. And then we signed a note payable for $170,000. All right, I'm going to stop there because the next step is that, and I know there's other transactions, and then they've also thrown in some errors that have been made that need to be fixed, but you could look at the solution for those, okay? So let's just look at just the cash account. So the cash account, come back here. Which is account number 11. It started with a balance of $26,300. All right? So we're going to post to the debit and credit side of the T account every transaction that occurred throughout the month that affected cash. So the first one was we paid some rent expense in cash. So $6,500 on April the 1st. And that was to account number 11. So you're going to see on your journal, just like in this solution, there's a column for the what they call the posting reference. And what I've done when I kept manual books is that when I post that cash transaction to the ledger, that's when I write the number down. So that tells me I did it. Because otherwise you could just quickly look through your general journal real fast and look for entries that don't have it. You know, if it doesn't have the number written in that column, then I haven't posted it yet. All right? So that's a very good way of staying organized on the midterm. So the second thing that affected cash was down here on the 5th, and we spent some more cash to buy an insurance policy. So there's $6,000, and that was 045. And then we collected some cash, so 0410. We collected $52,300. And then lastly, we spent $30,000 on the 15th. So I would have put an 11 there, an 11 there, and an 11 there. And then do the same for the rent expense, the office supplies, the accounts payable, the prepaid insurance, the accounts payable again, the land, and the notes payable. And write their corresponding numbers each time you carry it to the T accounts. And then you total up the T account. All right? Everybody with me so far? So at the end of the entire thing, your cash journal is going to have a balance of $19,050. So once you get a balance of all these T accounts, you can then do the financial statements. And that's what I want to spend the last 23 minutes doing. All right? So which of the three income statements do you have to do first? I know. It was a week ago. The income statement. Because you have to calculate net income in order to be able to carry that to the retained earnings statement, to calculate the ending balance of retained earnings, in order to be able to carry that to the stockholders' equity section of the balance sheet. So you have to do these three income statements in order. Okay? All right. Let's start. It's Elite Realty. This is the income statement. And it is for the month ending April 30th, 2016. The total of all the fees earned, the T account for fees earned, is $297,000. The various expenses that we incurred in order to generate that $297,000 worth of revenue includes salaries and commissions, $157,600, rent, $36,500, advertising, $22,100, automobile, $7,000, and then miscellaneous, $5,300. If you total all that up, you get $228,500 in total expenses. Subtract that $228,500 from the $297,000 in revenue that we generated during the month of April, and we get $68,500 as net income. And that's the income statement. The retained earnings statement and I'm just going to write the second line of the three-line header because it's the same. It's Elite Realty on the first line, and then the third line is for the month ended April 31st, 2016. All right? We start with the retained earnings. On April the 1st. Which it gave us in the problem as $36,000. To that, we're going to add net income that we just finished calculating at $68,500. Add those two together, we get $104,500 is a subtotal. And then you're going to subtract dividends. Of $6,000. Leaving us with $98,500 as our retained earnings balance on April 30th, 2016. So that's the first two of the three financial statements. On the midterm, the income statement is worth 20, and the retained earnings statement is worth 10 in total. So if you make a couple of mistakes, there's points off. But the big one is if you don't put the three-line header at the top, 3 points off. Don't do that. Okay? Because that's the easiest 3 points on the whole test. All right? Okay. Has everybody got this? Or at least this portion of it? Yeah, okay. Yeah, okay. The last one is the balance sheet. So Elite Realty balance. And this is just April 30, 2016. It is not for the month ended. It is not showing you activity. It can't. It is only showing you the moment in time at the stroke of midnight on April the 30th. So, assets are cash, which ended the month at $19,050. Accounts receivable of $66,200. Prepaid insurance $9,000. Office supplies, $3,775, and land of $200,000. Add all that up, you get $298,025 for total assets. We're good? Liabilities. We have accounts payable. Of $9,525. We have unearned rent of $10,000. And we have a note payable of $170,000. Total all that up, and you get $189,525 for total liabilities. Stockholders' equity. We have common stock. For $10,000. And we have the retained earnings that we just got finished calculating at $98,500. Add those two together, you get $108,500 as total stockholders' equity. Add the $108,500 in stockholders' equity to the total liabilities of $189,525, and the magic of numbers, $298,025 in total liabilities and stockholders' equity. Well, thank you. It's so sweet.
It's a real good.
I know. Does everybody know what this is for? put a long neck beer bottle in there. And it keeps it cold. Isn't that brilliant? That's great. I've got one that I take to the tailgating for football. And she saw me with it, and she goes, I have some of those. And I said, well, bring me one. And she did. So, all right, questions? Let me turn off the recording.